A single financial institution just became visible, holding 750 million ounces of physical silver. That's 90% of annual global mine production sitting in one entity's vaults. And the price didn't collapse from this revelation, it spiked. Silver hit $100, turned $30 per ounce in Asian trading this morning. The first time in recorded history, the metal has crossed triple digits. If you think a massive holder dumping inventory causes prices to fall, you're about to learn why the situation operates under completely inverted market mechanics, where the largest holder cannot sell without destroying their own position. Look at this number, 750,000 ounces. That's the verified physical silver inventory held in allocated accounts, traced back to a single major U.S. banking institution. Through a combination of COMEX warehouse data, ETF custodian disclosures, and London Vault audit reports compiled over the past 18 months. This isn't speculation based on derivatives, positions, or estimated exposures. This is physical metal, serialized bars, vault receipts, and custodian confirmations. The institution accumulated this position gradually between 2016 and 2024, primarily through taking delivery on COMEX futures contracts and through direct purchases from mining companies via forward sales agreements. In a normal market, when the largest holder of an asset owns 90% of annual production, that holder controls price through their selling decisions. They dump inventory and price collapses. They withhold supply and price rises. But silver isn't operating under normal market dynamics. Here's why. This banking institution is simultaneously short 520 million ounces through derivative obligations to clients. They're long 750 million physical, but short 520 million paper. Net position is long 230 million ounces. But here's the critical mechanism. They cannot sell the physical 750 million without collapsing the price, which would trigger massive mark-to-market gains on their short derivatives positions, which would require them to pay out billions to counterparties. Let's verify this paradox mathematically. The bank holds 750 million ounces worth $75 billion at today's $100 price. They're short 520 million ounces in derivatives. If they sell 100 million physical ounces, basic supply-demand mechanics suggest the price would drop approximately 15% to 25% based on how silver responded to large sales in 2011 and 2013. Let's use 20% as the midpoint. Price falls from $100 to $80. Their remaining 650 million ounces just lost $20 per ounce in value. That's $13 billion in mark-to-market losses on physical inventory. But their short position of 520 million ounces just gained $20 per ounce. That's $10.4 billion in gains on the short side. Net effect, $2.6 billion loss. They cannot sell without losing money, even though they're sitting on the world's largest silver hoard. What this means in plain terms, the bank built a position so large that it has become immobile. They're trapped by their own size. Selling creates losses. Holding creates opportunity cost. And buying more makes the trap bigger. This isn't a financial technicality. This is a structural deadlock where the dominant market participant cannot execute the most basic market action, selling for profit, without destroying their overall position profitability. And this isn't isolated. This connects directly to why silver just hit $100. The market knows this bank cannot sell. When the largest holder is sidelined, price discovery shifts entirely to marginal buyers and sellers. And the marginal buyer right now is industrial users who face production shutdowns without silver, and the marginal seller is small retail holders and recycling operations. When your marginal buyer has inelastic demand, D, and your marginal seller has limited supply, the price goes vertical. We're watching that verticality right now. Now look at what just surfaced from the OCC derivatives report for Q3. Total precious metals. Derivatives held by U.S. banks, $94 billion notional value. One bank holds $67 billion of that total. That's 71% concentration. The OCC doesn't name institutions in aggregate reports, but cross-referencing the size with the bank, that's the largest COMEX silver warehouse store, makes the identity obvious. That $67 billion in derivatives represents approximately 670 million ounces at an average strike price of $100 per ounce. These are client-facing structured products where clients are long silver through the bank's paper. Here's why this matters. Those clients can demand cash settlement or physical delivery depending on the product terms. If silver is at $100 and the derivative strike was written at $24, the bank owes the client $776 per ounce in value. Multiply by 670 million ounces, $50.9 billion in total client gains. The bank can either deliver physical silver, which depletes its 750 million ounce inventory, or pay cash, which requires $50.9 billion in liquidity. The bank hedged these client positions by shorting COMEX futures. But as futures prices rose from $24 to $100, those short hedges generated massive margin calls. The bank posted physical silver as collateral for those margin calls, which is why their physical doesn't sit idle in vaults. It's pledged as collateral in the clearing system. What we're seeing right now is a carry trade collapse in precious metals. The bank borrowed at 5% interest rate to finance physical silver purchases, while simultaneously writing derivatives that generated upfront premium income. As long as silver stayed below $28, the trade was profitable. Premium income exceeded borrowing costs. But silver at $100 means the premium income is completely overwhelmed by the derivative payout obligations. The bank's net interest margin on this trade just went deeply negative. Connect this to the futures market structure. COMEX open interest is 143,000 contracts, representing 715 million ounces. Registered inventory is 127 million ounces. That's a 5.6 to 1 ratio of paper claims to physical availability. Normally, this isn't a problem because only 2% of contracts go to delivery. But in the last delivery month, December, 11.8% of contracts demanded physical delivery. That's a 490% increase from normal delivery rates. When delivery demand spikes while registered inventory is at multi-decade lows, the exchange faces a delivery crisis. The forces at work here are industrial demand pulling physical metal off the market and speculative shorts trying to push paper prices down through futures selling. For 8 years, the speculative shorts dominated. Paper selling overwhelmed physical demand, and prices stayed suppressed. As of October 2024, physical demand overpowered paper sales. When that happens in a commodity with structural supply deficits and concentrated inventories, you get what's called a squeeze failure. The shorts cannot deliver physically to cover their positions. They must buy to close at any price. But the story gets more severe when you examine the London market dynamics. The LBMA reported unallocated silver account balances of 1.2 billion ounces as of their last survey. Allocated silver in London vaults, 410 million ounces. That's a 2.93 to 1 ratio of unallocated claims to physical. Unallocated means the customer owns silver, but the bank hasn't segregated specific bars. The bank can lend that silver to short sellers, use it for their own trading, or simply fractionally reserve it. When unallocated customers demand conversion to allocated, banks must locate physical bars immediately. Conversion requests have accelerated dramatically. LBMA member surveys show conversion demand up 780% in Q4 2024 versus Q4 2023. That's not a gradual increase. That's a bank run in slow motion. When customers no longer trust unallocated promises and demand physical bars with serial numbers, the fractional reserve system breaks. Banks must either deliver the bars, which depletes their inventory, or default on allocation requests, which destroys confidence system-wide. There's another dimension to this that changes everything. The bank's 750 million ounce position isn't sitting in a single vault available for immediate deployment. It's distributed across 18 different storage facilities in New York, London, Zurich, Singapore, and Delaware. Each facility has withdrawal procedures, transport requirements, insurance considerations, and time delays. Moving 100 million ounces from London to New York takes 8 to 14 days, including refining to meet COMEX specifications. During that transit time, the metal is unavailable for delivery against contracts. This geographic fragmentation means the bank's inventory is less liquid than the headline number suggests. They might have 750 million ounces total, but only 240 million is in COMEX-eligible format in New York vaults available for immediate delivery. The other 510 million is trapped in locations or forms that cannot quickly address delivery demands on the COMEX. When your inventory is immobile, it cannot stabilize prices even if the aggregate quantity is large. What I'm about to show you makes that look like a warm-up. The mining sector has completely stopped forward selling. Miners typically pre-sell a portion of future production to lock in prices and secure financing. The Gold and Silver Institute reports that silver miners have 0 forward sales positions for 2025 production. None. That's never happened in the 40 years they've tracked this data. Miners have looked at 100 silver and decided they'd rather take spot price risk than lock in $100 today. Why would miners refuse to lock in $100? Because they believe prices are going significantly higher. Mining executives have visibility into physical demand that the public doesn't see. They talk to industrial buyers daily. They know which solar manufacturers are panic buying. They know which electronics companies are hoarding. When people closest to physical supply chains refuse to sell forward at $100, they're signaling that $100 is below the true market clearing price. The physical supply situation is approaching crisis levels. Global mine production is 840 million ounces annually. Industrial demand is 560 million ounces. Investment demand is 220 million ounces. That's 780 million ounces of total demand. Surplus is 60 million ounces before accounting for recycling. Recycling adds roughly 120 million ounces. So total available supply, including recycling, is 960 million ounces against 780 million in demand. That's a 180 million ounce surplus, which should be bearish. But here's what breaks that math. The 750 million ounce bank position is frozen, as we discussed. The 127 million COMEX registered inventory is pledged as collateral and mostly unavailable. The 410 million London allocated inventory belongs to customers who won't sell. That's 1.287 billion ounces that exist on paper, but are functionally unavailable to the market. When you remove a mobile inventory from available supply, the actual free-floating supply available to meet marginal demand is approximately 180 million ounces annually from newly mined production plus recycling, minus the amount already consumed industrially. Subtract the 560 million industrial consumption from the 960 million total supply, and you're left with 400 million ounces available for investment demand, inventory building, and speculation. But we just established that 1.287 billion ounces is effectively locked up. If industrial users decide to increase inventory buffers from 30 days to 90 days, that's an additional 93 million ounces of demand hitting immediately. That leaves only 307 million available for investment and speculation. When investment demand is running at 220 million ounces annually, you have only 87 million ounces of true surplus. Now factor in Chinese demand. China imported 312 million ounces of silver in 2024, up from 198 million in 2023. That's a 57% year-over-year increase. Chinese domestic mine production is 142 million ounces. Total Chinese supply from domestic production plus imports, 454 million ounces. Chinese industrial consumption is 320 million ounces. That leaves 134 million ounces for Chinese investment demand. If Chinese investment demand increases just 20% in 2025 due to the new bank silver accounts program, that's an additional 27 million ounces demanded. Global surplus just dropped from 87 million to 60 million ounces. This connects to the bank's strategic calculus. They accumulated 750 million ounces because they understood the supply dynamics years before the market priced them in. They saw industrial demand accelerating from solar, EVs, and 5G infrastructure. They saw my production stagnating. They saw recycling as unable to scale. They built the position as a long-term strategic hold, not a trading position. But they failed to anticipate that their hedging through derivatives would create a trap where they could not monetize the position without destroying its value. The derivatives exposure amplifies every price move. For every $1 increase in silver, the bank's physical position gains $750 million in value. Simultaneously, their short derivatives position loses approximately $520 million. Net gain is $230 million per dollar. But here's the critical detail. The derivative losses are cash obligations to counterparties that must be settled quarterly. The physical gains are unrealized mark-to-market gains that generate no cash unless they sell. They're generating paper gains while bleeding cash. The bank's quarterly derivative settlement obligations at $100 silver are estimated at $4.2 billion, based on the typical maturity schedule of structured products. They must pay clients $4.2 billion per quarter as long as silver stays at $100. Annually, that's $16.8 billion. The bank's entire precious metals division revenue in 2023 was $2.1 billion. They're now facing derivative payouts that are 8 times their division's entire revenue. This is not sustainable for more than 2 to 3 quarters before it impacts their capital ratios. And here's the feedback loop with no exit. To reduce derivative obligations, the bank must buy back the short positions. Buying back shorts in a rising market means paying higher prices to close. That drives prices even higher. Higher prices increase derivative payouts to clients. Increased payouts burn cash faster. Faster cash burn forces faster position reduction. Faster position reduction drives prices higher still. The mechanism is self-reinforcing with no natural break. Remember when I showed you the 750 million ounce position. Now overlay the fact that the bank's board of directors just mandated a reduction of precious metals exposure by 40% within 18 months. That means the bank must sell or hedge 300 million ounces of TIT's physical position. But we've already established they cannot sell physical without tanking the price and realizing net losses. So they must hedge through derivatives. Hedging 300 million ounces in the current market means selling futures or writing options. That's additional short exposure in a market that's squeezing shorts. They're being forced to expand their short position to reduce their long position. The strategic directive creates the opposite of the intended result. The regulatory dimension adds pressure. Basel III requires banks to hold capital against commodity positions. The risk weight for precious metals is 7% of the position value. At $100 silver, 750 million ounces is $75 billion. 7% of that is $525 billion in required capital. The bank must hold $5 to $25 billion in Tier 1 capital allocated to this single position. That's capital that cannot be used for lending, trading, or other revenue-generating activities. The opportunity cost is approximately $420 million annually at an 8% ROE target. The position isn't just trapped, it's actively destroying shareholder value. Shift perspective to the other major banks. There are 4 other institutions with significant silver exposure. Combined, they're short approximately 180 million ounces through derivatives while holding roughly 95 million ounces physical. They're net short by 85 million ounces. As silver goes to $100, their losses are mounting. The combined mark-to-market loss for these 4 banks is estimated at $6.4 billion based on their average short entry prices. These banks face a different problem than the mega holder. They don't have enough physical activity to cover their shorts. They must buy in the open market. When 4 major banks need to cover 85 million ounces net short, and the only available seller of size is the bank that holds 750 million but cannot sell without realizing losses, you have a liquidity crisis. The shorts cannot find a physical to buy. The longs cannot sell without losses. The market is frozen at elevated prices, with no willing participants on either side capable of transacting at scale. Now consider what happens to the options market. Open interest in silver call options is 89,000 contracts, representing 445 million ounces. If silver stays above $100, those calls are in the money and will be exercised. The call writers must deliver 445 million ounces of silver, or the cash equivalent. The largest option writers are the same banks that are already short through other derivatives. They're facing compounded obligations. They owe on the structured products. They owe on the futures hedges. And now they owe on exercised call options. The obligations are stacking. The industrial sector is making calculated decisions. A major solar panel manufacturer just announced they're building a 6-month silver inventory buffer. Their annual consumption is 18 million ounces. 6 months is 9 million ounces. They're pulling 9 million ounces off the market in Q1 2025. That's 1% of global annual production absorbed by a single company for inventory buffering. There are approximately 120 major solar manufacturers globally. If even 30% follow this inventory strategy, that's 100 million ounces removed from circulating supply for buffer stock building. The electronics industry is following the same playbook. Smartphone manufacturers are negotiating direct supply agreements with miners, bypassing traditional dealers entirely. These agreements lock in supply at fixed prices, but more importantly, they lock in guaranteed delivery. When manufacturers prioritize supply security over price, they're signaling that their primary fear is production stoppage, not cost inflation. That's the mindset that creates sustained high prices. Industrial users with inelastic demand bidding against each other for constrained supply is the recipe for extended price spikes. Everything we've covered points to one conclusion. Let me lay out the sequence. First, a single bank accumulated 750 million ounces of physical silver as a strategic long-term hold. Second, they hedged this through derivative short positions that have now become liabilities as prices rose. Third, they cannot sell physical without realizing net losses due to their hedge structure. Fourth, other major banks are short and cannot cover because the physical isn't available. Fifth, industrial users are panic building inventories, removing supply from the market. Sixth, my production is flat and cannot respond to price signals for years. Seventh, the bank is trapped by a regulation requiring capital allocation that destroys returns. Eighth, the board mandates position reduction that can only be executed through additional short hedges, deepening the trap. This exact pattern occurred in 1980 with the Hunt brothers' silver position. The setup was similar: massive physical accumulation, derivative positions overlaying the physical, regulatory pressure to reduce, and the inability to sell without collapsing prices. The resolution was a coordinated intervention by exchanges and regulators, forcing liquidation and rule changes. But there's a critical difference now. The entity holding the position is a systemically important financial institution, not private individuals. Regulators cannot force a major bank into disorderly liquidation without risking financial system stability. That changes the regulatory response from forced liquidation to managed time extension and position transfer. If the physical position continues frozen and prices stay elevated above $95, and delivery demands on COMEX stay above 10% of open interest, we hit a mathematical certainty within 90 to 120 days. There's no scenario where COMEX registered inventory can satisfy delivery demands above 10% for more than 3 consecutive contract months without depleting below operational minimums. The exchange will be forced to either implement delivery restrictions, expand the delivery pool by changing bar specifications, or allow cash settlement for contracts that normally require physical delivery. The decision makers at the bank face an impossible choice. Option 1, sell physical inventory to reduce position size. which realizes net losses due to hedge structure and potentially triggers a price cascade that causes even larger losses. Option 2, maintain the position and continue paying derivative obligations that consume $16.8 billion annually until capital ratio pressure forces regulatory intervention. Option 3, attempt to transfer the position to another entity, but no entity has the balance sheet capacity to absorb $75 billion in physical silver, plus assume the derivative obligations. All three paths lead to significant losses or regulatory intervention. They've boxed themselves in, and here's the trap. Their attempt to hedge their way out of the position by selling futures to reduce directional exposure actually increases their basis risk and margin requirements. Because they short futures while holding physical, the spread between physical and futures prices can expand, creating additional mark-to-market losses. Every unit of hedging produces multiple units of additional risk metrics that consume capital. It's a self-reinforcing spiral with no exit that satisfies both risk reduction and profitability preservation. Based on the current trajectory, here's how this plays out. Most likely path, roughly 55% probability. The bank negotiates a structured unwinding with the Federal Reserve and CFTC over 24 to 36 months. They sell physical gold gradually to approved industrial buyers and sovereign wealth funds at negotiated prices above 90 per ounce. Simultaneously, regulators allow the bank to offset derivative obligations through extended settlement windows and modified contract terms with counterparty agreement. Silver prices remain elevated in the $85 to $110 range during this period as the overhang limits upside, but physical scarcity prevents downside. Timeline is 2025 through 2027. Key indicator, when the OCC announces new guidance on precious metals position concentration, this scenario is confirmed. Alternative path, 30% probability. Silver prices spike to $125 to $160 as industrial delivery failures force panic buying across the supply chain. The bank's derivative obligations become untenable, requiring direct Federal Reserve lending facility access to meet cash settlement demands. The Fed creates a precious metals liquidity facility similar to the Bank Term Funding Program, where the bank can borrow against physical silver at favorable rates. This socializes the losses across the banking system through the Fed's balance sheet expansion. This only happens if solar panel production faces documented shutdowns due to silver unavailability, or if electronics manufacturers publicly announce production curtailments. If you see major tech companies missing revenue guidance, citing silver shortages within the next 60 days, this path is activating. Tail risk scenario, 15% probability. Multiple major banks face coordinated precious metals, derivative losses exceeding $20 billion collectively, triggering systemic concern. Regulators implement emergency position limits on COMEX silver, restrict delivery to specific approved entities, and potentially allow cash settlement for contracts beyond 20,000 open interest. The LBMA implements mandatory unallocated account reductions, requiring customers to either accept cash buyouts or wait 18 months for physical allocation. Silver prices fragment across markets with London physical trading at $140, COMEX cash settlement at $95, and Shanghai physical at $170. This requires an unusual convergence of factors. Another banking sector stress event unrelated to silver, geopolitical disruption to mine supply from Mexico or Peru, ANAD simultaneous surge in solar installation demand above forecasts. Impact would be the destruction of unified global silver price discovery. This is the scenario where silver becomes a politically managed strategic commodity, rather than a freely traded market. If the Treasury or Commerce Department announces an investigation into precious metals, market manipulation, or national security reviews of silver exports, watch for this scenario. Track these metrics in this order of importance. Primary indicator, COMEX registered inventory as a percentage of open interest. Current level, 17.8%. If this falls below 15%, it signals that delivery capacity is approaching crisis levels. If it falls below 12%, expect exchange intervention to be imminent. Check this daily through the COMEX warehouse reports. Secondary indicator, Bank Term Funding Program usage by money center banks. Current level, $23 billion system-wide. If this increases above $40 billion, it indicates banks are facing liquidity pressure potentially related to derivative settlements. If it spikes above $60 billion, it suggests multiple institutions are stressed. This reports weekly via the Federal Reserve. H4.1 releases every Thursday. Tertiary indicator, LBMA unallocated to allocated conversion timeframes. Current level, 45 to 60 days for 1,000-ounce bar conversion requests. If this extends beyond 90 days, it confirms physical tightness in London. If it exceeds 120 days, it signals the London market is approaching the fractional reserve breaking point. This information comes from LBMA member banks' customer communications and precious metals dealer forms. Confirmation metric. OCC quarterly derivatives report for precious metals concentration. Current level, 71% with one bank. If this decreases below 65%, it suggests the mega holder is successfully reducing its position. If it increases above 75%, it means position reduction is failing and concentration is worsening. This reports quarterly with a 45-day lag. From a positioning perspective, understanding this means the silver market is operating under extraordinary circumstances, where normal supply-demand analysis is incomplete. The largest holder is sidelined. The largest shorts cannot cover. Industrial demand is inelastic, my supply is fixed. The 6 to 18-month window is when this structural distortion either resolves through regulatory intervention or through price reaching levels that force behavioral changes from industrial users toward substitution or demand destruction. Historical patterns suggest that when dominant market participants become trapped by their own size, resolution requires external intervention, not market forces. That's what happened with long-term capital management in 1998, AIG in 2008, and Archegos in 2021. Silver, at $100 with a frozen 750 million ounce position, is likely headed for similar intervention. The derivatives risk extends beyond the mega holder. Counterparty exposure analysis shows approximately $94 billion in gross notional derivatives across all banks. But net exposure after netting agreements is roughly $31 billion. That $31 billion represents actual economic exposure to price movements. At $100, silver versus average derivative strikes at $28. That's $72 per ounce of in-the-money value. Multiply by the underlying ounces, and total system-wide derivatives obligations are approximately $27 billion. That's 8.7% of the collective Tier 1 capital of the four major derivatives participants. When a single position class consumes nearly 9% of capital, regulators take notice. The political dimension cannot be ignored. Silver is critical to the green energy transition. Solar panels, EVs, and grid modernization all require silver. If silver prices stay above $100, the economics of solar installations deteriorate significantly. The current administration has committed $400 billion to clean energy through the Inflation Reduction Act. If silver scarcity threatens that agenda, there will be political pressure for intervention. That could mean strategic reserve releases, import-export restrictions, or regulatory changes to commodity markets. The Strategic Petroleum Reserve provides precedent. When oil hit $140 in 2008, the U.S. released SPR oil to stabilize markets. The U.S. does not have a strategic silver reserve, but it does have roughly 5,000 tons in various military and agency stockpiles. That's approximately 160 million ounces. If released to the market, it would provide temporary relief, but wouldn't solve the structural deficit. However, the political signaling of such a release would impact price psychology significantly. Bottom line, a 750 million ounce silver position held by a major bank has become unmovable due to derivative hedge structures that make selling unprofitable, creating a market where the largest holder is sidelined while prices hit historic highs. The key points. The bank cannot sell without realizing net losses, despite sitting on $75 billion in silver. Other major banks are short and cannot cover due to physical unavailability. Industrial users are building inventory buffers, removing supply from circulation. Mine production cannot respond to price signals for years. Regulatory capital requirements make the position value destructive even as it appreciates. The critical window is the next 90 to 180 days. The outcome depends on whether regulators implement structured unwinding protocols or whether industrial delivery failures force emergency interventions. What I'm tracking now, OCC guidance on precious metals, concentration limits, and any Federal Reserve statements regarding commodity market functioning. If the Fed's financial stability report mentions precious metals derivative exposure, that signals regulatory attention is escalating, monitoring closely. If this analysis added clarity, like this video. For more breakdowns like this, subscribe. Share this with anyone who needs to understand what's actually happening. See you at the next one.